Welcome to the BKL seminar on property VAT and CIS for investors. I'm Jason Appel, a partner here at BKL and part of the property team. And now I'm not a property entrepreneur, thankfully. So I'm not going to try and sit here and tell you the whys and wherefores of the property industry as it is at the minute and the challenges that face you. We understand it's a challenging market. That said, plenty of people are telling us they're hopeful for the rest of the year with plenty of activity in the pipeline. So as a practice, we're lucky enough to have a very strong team here for property businesses. From Andrew Levine, our property tax director, who deals with our direct property tax, and Simon Levine, who is our property VAT specialist, as well as a dedicated compliance team that specialises in the compliance business. So we know what to look for when preparing your accounts and dealing with your affairs to point you in the right direction. Property transactions require a consideration of most taxes: VAT, STLT, CIS, corporation tax, income tax when considering extraction of profits, etc. So there's a wide range of areas that we can help advise on. Those that are already aware of BKL know that we deal with structuring considerations all the time, but I think we'd need more than an hour's webinar to go through every type of property transaction, situation and tax to cover that and satisfies everybody's answers. So today we're concentrating on VAT and CIS. From VAT we have Simon Levine, and for CIS and services for overseas clients we have Petra Dieters, who heads up a new service line at BKL servicing German clients investing in the UK. So before we get going, I'm just going to ask each one of them to give a brief introduction of themselves. Simon, do you want to just take control and give a brief intro?
Yeah, thank you very much, Jason. So good afternoon, everyone. So my name is Simon Levine. I'm the head of VAT here at BKL. Whilst I cover all areas of VAT, my main specialism is property and construction, and I deal with all types of commercial, residential, charitable, new build, conversion, so everything to do with VAT and property and construction I deal with. Petra.
Well, hello everyone. My name is Petra Dieters. I'm a director in our Advanced Business Services department. My focus for over 20 years has been what we used to call outsourcing, so bookkeeping, management accounts, VAT returns, and CIS returns. I've also, if you've picked up a German accent there, I am originally from Germany, so I've worked with German companies coming to the UK also for over 20 years, seen a lot of them, being involved in construction projects and engineering projects that fall within sort of the CIS rules, and so I've got plenty of experience in that area, which I'd like to share with you later on. Thank you.
Okay, so I'll just give a brief overview of what we're going to be covering today. So from a VAT point of view, we're going to look at an overview of property VAT, various rates and types of structures and how that impacts, specifically on demolition and new build residentials with some options and tax considerations, properties with transfer of going concern, and at the end of Simon's presentation, we'll take some questions. There is a Q&A button at the top of your screen. If you want to put some questions in there throughout the presentation, we'll try and pick those up at the end. Same goes for Petra's presentation. If we can't get to all the questions, if we're inundated, which I'm sure we will be, then the guys will seek to come back to you after the presentation. And again, if any points come to your attention that this presentation has spurred a thought at some point in the future, then obviously don't hesitate to contact us. So with no further ado, CIS, we're going to have a look at the overview of CIS, contractor versus deemed contractor, property developer versus property investor, the obligations that you have, and then come on to your questions. So Simon, I'm going to hand over to you to impart your knowledge on everybody here. If you want to click the take control, and ahead you go.
Lovely. Well, thank you very much, Jason. Well, good afternoon, everyone. Obviously, I've only got 15 to 20 minutes. So what my intention is to mention some very important points, some basic points in relation to VAT and property construction. And then obviously, if we can go into, if you have any questions, we can go into more detail later on. Now, with regard to overview of property VAT, obviously there's a lot going on in the property construction market at the moment, even within residential. Developers and certainly local councils are trying to come up with different ways of allowing different types of developments. For example, there's historically there was one called live work units, which was effectively simplistically a flat, but there was a specific work area in it. And there's also new developments coming through of blocks of flats, but where there's basically open working space for the residents of the block to work, and that can have its own VAT implications. Also, I'm finding when I see a lot of planning permissions, what a client might actually apply for, the council sometimes, because of their own policies or what they want, they might slightly change the decision notice or what they're going to allow, and that needs to be looked at, and sometimes can actually have an impact on the VAT. So let's look at the first thing in relation to various rates of VAT. Now, with regard to construction, if you're constructing a new building, there can be zero rating allowable for certain developments. Now, where you construct a new build dwelling, a relevant residential building, or a relevant charitable building, that is zero rated, i.e., the contractor does not charge you VAT. If you have a design and build contract with the contractor, so not only are they supplying you with the labor, the materials, but also professional fees, that package can come across at the zero rate as well. So a design and build purely from a VAT point of view is a very good way of minimizing the VAT impact or hit in the first place, especially if you're not going to get the VAT back. There are some exclusions where you will always pay 20% VAT, but again, they're relatively minor towards the end of the fit out stage. But again, I haven't got enough time to cover all of those today. And then if you're constructing a commercial building, now this could be commercial, retail, or offices, it's always standard rated. There's a popular misconception I see quite a lot where people think that just because a building is new build, it's zero rated. It's not. It has to be for the first three mentioned there. Now, what are examples of new build residential dwellings? It's a self-contained house or a flat, and the live part of live work units. A new build must be completely new, either on bare land, underneath, side, or on top of an existing block, but cannot utilize any of an existing building. So if you've got a flat, or if not, let me give you an example. You've got a house and you're doing a massive big extension. The extension is not zero rated because it's not entirely, the structure is not entirely new build. It's purely an extension to the existing building. That's why it's not zero rated. Also, if you've got a block of flats with a flat roof, and you're going to build new flats on top of the flat roof in essentially what is airspace, that can be zero rated because the new flat is purely outside of the existing building. And I've had a few cases, certainly within London, where people have excavated under their existing house to create a new flat. Pure excavation, not utilizing a former basement, and that can be zero rated as well. Now, if there's an existing building on the site, it either has to be fully demolished to ground level first, or you're only allowed to keep one and sometimes a double front facade. Obviously, facade retention scheme. I'll cover those a little bit later. Now, people might think, well, a dwelling, well, it's nice and simple. Well, what's so complicated about a dwelling? Now, in order to get zero rating for a dwelling, the dwelling must meet all of these four conditions. If any one of these conditions are not met, then it's not zero rated because it's not a dwelling. All right. So what are the four conditions of a dwelling? Number one, self-contained accommodation. Toilet, bathroom, kitchen, kitchenette. That's nice and straightforward. No internal access between the flats. So if you're in a block of flats, typically, if you want to go from one flat to the other, you can go you have to go out into the communal hallway and back in. That's fine, no problem. What HMRC are referring here to is if you have in a hotel where you have two internal interconnecting rooms that you can go from one to the other internally, that's what they are trying to avoid here. Now, to be honest, virtually all developments of blocks of flats that I see, there's no internal doors between flats, but in case there is, you need to bear that in mind. Built in accordance with the granted statutory planning permission. Again, people might think, well, this is actually obvious, but surely if we're going to build in accordance with the planning. But I have seen a few cases where during the course of a project, people want to do things slightly differently. Is it need planning? Maybe, maybe not. And they just try and do it. But you just got to be careful. If HMRC come along and actually look at the project, they will want to make sure that what was actually granted planning wise has been undertaken. And then the last one is no restriction on separate use and disposal. Now, we're not talking here about, let's say, if you saw a block of flats that only people over 55 can go and live in, or only students. That's not the restriction we're talking about. The example of this is, let's say, and I find this a lot certainly within London, that a lot of the bigger houses have got very large gardens. And a number of times the parents will think, well, we've got older kids, we want them out the house, but what we'll do, let's build them a bungalow at the bottom of the garden where they can go and live, have a bit of independent living. So they apply to the council for planning permission. So if you look at the conditions of a dwelling, is it self-contained accommodation? Virtually always yes. No internal access between the dwellings. Well, again, it's a detached bungalow, no problem whatsoever. Built in accordance with the granted statutory planning permission. Yep, that's absolutely fine. That'll be done. But what you generally see is there'll be a condition which says this bungalow can only be used in conjunction with the main house, or it can only be seen as ancillary to the main house. There's your restriction on the separate use and disposal. And there has been a number of VAT tribunal cases over the years, and where that restriction is in there, basically it has ruined the zero rating. So that is the one. If you're building that bungalow, and one of the other examples of this is a granny annex. If you're building a granny annex next to your main house, that last bullet point is the thing that will ruin zero rating. So just bear that in mind. Okay. Now, what are examples of relevant residential? Care homes, hospices, hostels, and student accommodation. As it happens with student accommodation since 2014, HMRC do now accept, subject to meeting certain conditions, that student accommodation can be considered dwellings. A lot of the developments that myself and Jason get involved with, and we deal with a lot of very large student accommodation developers, is we try and make sure the planning is as dwellings, not as relevant residential, mainly because dwellings is more flexible, which I'll come on to in a second. And what is relevant charitable? Effectively, it's a new building built by a charity, either not to be used for business purposes, or as we call, not in the furtherance of course of business, or used as a village hall. Now, one of the things you have to be very careful here is you might have a charity building a new building. They might want to go in there self-occupied, but and whilst the charity might generate a lot of exempt income, some of that exempt income might be business. Now there is a 5% buffer, but you just have to be very careful. And if you have got a charity who's looking to build a new building, you got to look at that in detail, what their usage and income streams in the building will be. Now, the reason why, specifically in relation to student accommodation, people like to try and get the student accommodation as dwellings rather than relevant residential is partly in relation to VAT certificates. That essentially, if you have a new building that's going to be for relevant residential or relevant charitable purposes, you have to, or the property owner, the one who's commissioning the work, has to issue a special VAT certificate to the contractor before the work, ideally before the work start. It should be done before the work start, although if it gets missed, there are some cases when we can do a retrospective certificate. But the importance is, if you have every single other condition for a 0 rating, but you don't have the VAT certificate, you've blown the 0 rating. It's very, very important. And then one of the things, believe it or not, I get asked on a very regular basis when I'm advising a client who's building a house or houses or flats, is they say to me, oh, the contractor wants a VAT certificate. There is no VAT certificate for dwellings. The certificates, as I said, are only for relevant residential or relevant charitable. They're not for dwellings at all. Now, apart from 0 rating, there is actually a reduced rating of VAT. It's at the 5% VAT rate. And this is something that's been in since 2001. And this is obviously for non-new builds. But what amazes me is still the number of, especially contractors out there, which are not really sure of the rules or when they come in. Now, whilst there are a number of different types of developments that would qualify for the reduced rate, the two main ones are here on this slide. So the first one is you're refurbishing an existing residential property that has been empty for more than 2 years before the refurbishment work starts. Generally, it means not lived in. Again, I'm going to cover a few exceptions. The other one is changing the number of dwellings. So if you're changing the number of dwellings up or down, there's no problem. The people can move out the day before. The 2 years doesn't apply. But as long as you're ending after the change with at least one dwelling. Now, typically where this comes in is I've had a project recently where a client has got a house that he's got planning permission to split it into 3 self-contained flats. Therefore, we're going from 1 to 3. The work from the contractor will be at the 5% VAT rate. It would have been the same in reverse. Also, HMRC say that in relation to when you're working on blocks of flats, you can actually work on a floor-by-floor basis. So, for example, if you've got a 4-story building, and let's say you have 3 flats on the top, 3 flats on the bottom, and the top floor, you're splitting 1 flat into 2, and on the bottom floor, you're merging 2 flats into 1. So if you look at the building as a whole, you're not actually changing the number of dwellings at all. However, because you're changing the number of dwellings on the top floor and you're changing the number of dwellings on the bottom floor, the work on the top and bottom floors that relates to that change can come in at the 5% VAT rate. So it can work that way. Now, in relation to the 2 years empty, it's the 2 years immediately before the work start on site. It's not any 2 years. It's you look at when the builder physically goes on site, and it's at least 2 years prior to that point. Now, there is certainly, again, in the southeast of England, there was a number of years ago a pandemic with squatters, people breaking in, or should I say breaking into, people occupying very big houses in some wealthy areas and squatting, and it got very expensive to get the squatters out, apart from the damage that they did. So a new industry basically sprouted up called guardians, where effectively a guardian company will be engaged by the property owner to essentially have people live there to protect the property, to show that it's lived in. And HMRC have accepted that if you have guardians to go in there to protect against squatters, they'll ignore that use for the purposes of the 2 years. Now, normally, if I have, and I have had a number of these cases where, let's say, the house was empty for a year and we had guardians in for a year, what I've generally done is I've asked for a copy of the guardian contract and a covering letter from the guardian company, just sort of saying, we confirm that we were in this property from this date to this date, protecting it as guardians. It's just to show HMRC that they were specifically engaged for that purpose. And then you keep that on file. And generally, I found the guardian companies have been very helpful, even if they were guardians for the previous owners. So we need reliable third-party evidence for the 2 years empty. And the best evidence, what I call the gold standard evidence, is something from the council. So council tax bills with an empty house discount. So that will actually show the dates that it's been empty. There has been for a number of years now a 2-year empty premium. So actually, when the dwelling has been empty for 2 years or more, the council will charge an additional council tax, and it will actually say on the bill, long-term 2-year empty premium. So it's actually fairly good evidence that the place has been empty for more than 2 years. So what you'll see on the bill is it'll give a date that the 2-year premium kicks in, and that is the date that the dwelling has been empty for at least 2 years. HMRC do say that their best evidence is a letter from the empty housing officer of the relevant council. Now, the problem is I found over the years that a lot of councils don't have an empty housing officer. And sometimes you don't, even if they do, sometimes you don't hear from them. So generally, I would go for as much evidence from the council with regard to council tax bills that you can. If you can't get the council tax bills or the empty housing officer letter, then you should get electoral roll for the 3 previous years to basically try and prove that nobody has been registered there to vote. Utility bills, if you get 2 years of utility bills, so you got a reading at the beginning and the reading at the end that are actual readings, not estimates, you can probably show, hopefully, that there's very little usage, and that's other evidence. And then lastly, a letter from the agents who dealt with the sale for them to confirm when they had the keys, when it was empty. That's also helpful. When you move away from the confirmations from the council, that's when you need more. Don't just rely on one piece of evidence. You should always gather as much as possible. Now, when you're talking about a change of number of dwellings, well, what are we talking about? What examples are we talking about? A non-residential building is being converted into single household dwelling, HMO or relevant residential. A multiple occupancy dwelling is converted into a single household dwelling or relevant residential. A number of single household units are changing in the building, and I mentioned that in my example earlier. A relevant residential building is converted into a single house HMO or block of flats. One project I worked on recently was a care home was converted into 25 self-contained flats, and that we managed to get through at the reduced rate. So reduced rate. Now, what do you need? These are just additional points. Planning permission and building control. Now, if you're just refurbishing, like a strip out and refurb of a house under the 2-year rule, you don't need planning permission. Just go ahead and do it. But obviously, if planning permission is needed for a split, a conversion, extension, you need to have the planning permission and you need to have it in place before the work starts. Retrospective planning is problematic to get the 5% VAT rates. Very difficult, arguable, but very difficult. If there's a separate fee for design, that has to be 20%. That's not 5%. There's also, if you're installing some energy saving materials, and that again is like insulation, like to the roof, the walls, the floors, under certain conditions, it can now be zero rated until 2027. Prior to that, it was actually 5% VAT rate. But again, if you have a client or a specific query on that, please come and see me, because it's not everything, but I can advise on that. I have done so. And then goods supplied by the same builder and installed on qualifying services can be at the 5% VAT rate. So I've got a number of projects I've had where, let's say, a client is converting offices to flats, and they want to get the kitchen suite or the bathroom suite. What they generally do is they ask the contractor to buy in the materials at 20%, the flat pack, sinks and showers and everything, and then the contractor will install it. Therefore, the contractor gets charged 20% VAT by the material supplier, but when they recharge across to the client under supply and install, they only charge a 5%. Now, that means essentially you're using the contractor to get the 15% VAT back. Now, assuming that the contractor is not charging or is only charging a handling fee under 15%, then it's worthwhile. Now, obviously, you need to take the specific circumstances to see if you need to bother about whether or not you're going to get VAT recovery anyway. Now, Jason, can I just ask, sorry, have I got just a few more minutes? Yeah, okay, lovely. So demolition of existing building to get the new build residential. So where an existing dwelling is being demolished and a new dwelling built in its place, then it can be zero rated if the former building is fully demolished to ground level or below. So everything above ground level must be demolished. The only exceptions to that on the next one is if you've got a building and building party wall with the building next door, that can stay. So if you're a semi-detached or you're in a terrace, clearly you can't knock down the building on building party wall next door. It has to stay. And HMRC are comfortable to say that can remain. Now, if you can't demolish the full building and the only part you keep is a single facade, or if it's a corner plot or double facade, then if everything else goes behind the facade, then that's fine. This is a particular problem in London. Most of London's boroughs have got a large area of conservation areas, and there's a general policy against full demolition. That's why facade retention schemes are quite common in London. So as I said, if you get the proper permission and it's applied for in the proper way and everything is demolished behind the single or in some cases double facade, we can get the rebuild as a zero rating. However, if you keep more than the parts of the facade that you're allowed to, you've blown zero rating. I dealt with a case in one of the nicer areas of North London, and they went for a facade retention scheme. I saw the planning permission, exactly what I had to have on there. However, when I saw the actual proposed plans, there was a bit of a flanking wall or two flanking walls being kept on either side, effectively to hold up the front facade. That was enough to blow the zero rating, because the intention was to keep those and not demolish them. Thankfully, the client came to me before they'd started the works. We were able to put in a non-material amendment and get rid of those little flanking walls and effectively preserve the zero rating. Otherwise, it could have been a very, very costly mistake. And again, the point on that one is it was very clear that the two bits of flanking walls were being kept to hold up the facade. That's fine. But the VAT law said anything in addition to the front facade has to go. And obviously that would have been problematic. Now, that's all to do with residential. And we move on now to commercial, office and retail. So what is an option to tax? Effectively is where you make a building VATable or make a VAT election over the building. Every purchaser or owner of a property must make their own election. Just because a previous owner opted to tax does not mean it's opted for every subsequent owner. This is a question I get a lot with transfer of going concerns. Every owner must make their own option. It must be on a form 1614A and submitted ideally an email to the option to tax unit in Glasgow. Must be done promptly, because if it's done late, it could actually cause a transfer of a going concern to fail or input VAT to be lost, especially if permission is needed. There are some cases where clients want to belatedly notify HMRC. Maybe they thought they did, but they didn't, but they've been acting as if they did. So that can be accepted by HMRC in limited circumstances. Now, one of the important points to make is people might be aware the option to tax notification rules changed on the 1st of February 2023, but HMRC have confirmed that when you're applying for a belated notification, that will be dealt with. That has not changed. That will be dealt with under the old way, so that will still be looked at. And then lastly, just want to touch on property transfers of a going concern. This is something Jason and I deal with on a large basis. There's a very vibrant property deal market at the moment, and there has been, at least certainly for the last 6 to 12 months, I've been incredibly busy. So what this is where you're transferring from a seller to a buyer, a property rental business, that if done correctly, there should be no VAT payable on the sale and therefore have to be reclaimed. One of the reasons clients, or two reasons that clients would like to try and get a purchase as a transfer of going concern, apart from the cash flow of having to pay out the VAT and get it back and having maybe to use mezzanine funders, even if you get the VAT back, you have to pay stamp duty on the VAT element as well. And that can be costly. So where possible, clients want to try and structure a purchase or get a purchase as a transfer of going concern. So where do typically, and these are only some of the examples, but these are the typical examples we see. One is where you own the freehold of a property which you let to a tenant and sell the freehold with the benefit of the existing lease. A business or property rental is transferred to the purchaser. This is a business transfer as a TOGC, even if the property is only partly tenanted. So you don't have to have the building fully tenanted. A lot of times, and certainly unfortunately since COVID, a lot of the deals I'm dealing with, there may be 1, 2, or 3 floors that are vacant, but then there might be a few other floors which are tenanted, and that's fine. The whole building comes across as a TOGC, subject to all the conditions being met. Another example of a TOGC is you own a building where there's a contract to pay rent in the future, but where the tenants are enjoying an initial rent-free period. Even if the building is sold during the rent-free period, you are carrying on a business of property rental. Granted the lease in respect to the building, but the tenants are not yet into occupation, own a property and have found a tenant, but have not actually entered into a lease when you transfer the freehold to a third party, but it's with the benefit effectively of agreement for lease. So if you sell a vacant property, but there's an agreement for lease with the potential tenant, and the only reason the lease hasn't been granted is it hasn't been finished yet, that can be a TOGC. And then when you're granting a 999-year head lease with the benefit of the underlying tenant, it's what we call the Robinson case. That can be a TOGC, but that is if the value of the freehold of the part that's transferred is less than 1% of what it was before the 999-year lease was granted. So there we go. As I said, I had to try and cover a lot in a short space of time. It was very high value, it was very high level, but hopefully it got some important points out. So if anyone has any questions, we can ask now or wait until after Petra has done hers and we can answer together. Thank you. Jason, you're on mute.
Thanks, Simon. Thank you for running through that. That was, yeah, as you say, a lot of information in a short period of time. I'm sure there's some questions that you can imagine I've been inundated. I haven't with questions. But if you do have anything you want to ask, please feel free to put in the Q&A and we'll pick them up later after Petra or a further point in the week. So moving on to CIS, I'm going to hand over to Petra. Construction Industry Scheme. Thanks, Petra.
Thank you. And thanks, Simon, for the insight into the VAT. And we titled this webinar as Property VAT and CIS for Investors. But as we've probably learned already from Simon's presentation, there is a lot of development going on very often, even if you just want to buy and sell a property. So that's why I felt we should tell you a little bit about the construction industry scheme as well. Okay, so I know there are some accountants on this webinar, so you obviously will know this, but for those who aren't accountants, the construction industry scheme was basically put in place many, many moons ago to address tax avoidance in a cash-heavy construction industry. CIS deductions that a contractor would make are considered on-account payments for income tax that your subcontractor would have to pay at the end of the year. So basically, there is an obligation to withhold tax, which is put on the contractor, a little bit similar to the payee that you withhold on any employees. income tax. It applies to all payments made from contractors to subcontractors. So what are payments? These are obviously payment bills, but it would also include advances, on-account payments, cash floats, or later on retention payments. These are only payments that you make in relation to labor on site. So it's not payments for materials. There's a particular payment period, which is the 6th of the month to the 5th of the following month, which is the UK PAYE period. We have this odd non-calendar month tax year. It covers all construction work carried out in the UK. Now let's have a quick look as to what construction work actually is. So starting with site preparation. Now, so what's not included is design, the work of surveyors or architect services. So we're really just looking at work taking place on site. It includes alterations, dismantling, construction, repairs, decorating, demolition, or any type of work that happens on site as part of a construction contract. So for example, if you build a number of flats and as part of the contract, there's some end cleaning involved, then cleaning could fall into the CIS scheme. Each of these has got very detailed definitions. So for example, if you look at heating and air conditioning systems. Now, of course, the offsite manufacturing of those is not part of CIS, but installing them on site will fall into CIS. But if you then have an annual service taking place, that's again not CIS. So it's really important to look at the work program to say which part falls into CIS and which one doesn't. Now, one of the things that's really important when looking at CIS is the definition as to who is a contractor and who's not a contractor. Now, HMRC only differentiates between a contractor and a subcontractor. They don't know the term main contractor. A main contractor can be both a contractor and a subcontractor. So there are two kinds of contractors, a mainstream contractor, so that's not the same as a main contractor, and a deemed contractor. A mainstream contractor is any business that include construction operations and pay others for such work carried out. So the one area CIS never applies is on private households, so on buildings that you yourself live in. So if you have a loft conversion or whatever conversion going on there, that will not fall under CIS. A mainstream contractor is any property developer or speculative builder erecting and altering buildings in order to make a profit. So the intention really here of a contractor is to increase to build something, to create something new, to create something different, and then make a profit out of that. A deemed contractor can be any other business where the cumulative expenditure on construction operations exceeds 3 million within the previous 12 months, and these are rolling 12 months. So a property investor that spends more than 3 million will always need to apply for CIS on payments to subcontractor. The scheme specifically mentions that CIS must be applied on expenditure for construction work on any property that is not used for the purpose of the business. So for example, if you are a manufacturing company and you build a new plant, and that may very well, be more expensive than 3 million. you still will not be a property developer if that land is used as part of your business. A property that is for sale or let, or is held as an investment. However, there is a risk that a property investor could become a property developer. So a property investor, the definition, HMRC's definition says it acquires and disposes of buildings for capital gains, or it uses the building for rental purposes, but they are not involved in the construction, alteration, or extension of buildings. So if the entity simply buys and rents the site, then it is a property investor. And any work they undertake on those, say, on a bunch of flats, if it just, in line with some general maintenance they need to do, then they do not need to operate the construction industry scheme if that work is less than 3 million over a 12-month period. And I think to spend 3 million over a 12-month period, you'll have to do quite a lot of considerable maintenance. Now, with things like, climate change agenda and the push for property investors to make sure that houses are more energy efficient, there is obviously more investment going on, more work going on. But at the end of the day, you need to be quite a large property investor to spend that amount of money on those type of construction works. So where is actually the risk? So HMRC guidance on the definition of a property developer says a property developer is the activity that creates a new building, renovation, conversion of existing buildings, or other civil engineering work. So we often speak about something, that wasn't there before, or that it's altered, the purpose of it is altered considerably. If you just buy a piece of land and build a new property, then you automatically become a property developer. Now, a property investor that enters into multiple or substantial contracts relating to construction operations for the purpose of development of one or more properties is at risk to be seen as a property developer. Now, the question obviously here is, what is considered as being substantial? Now, when you look at the construction industry schemes, there are hardly no particular limits mentioned. There's one limit that says, if you pay a subcontractor less than £1,000 as a one-off payment, then you don't need to apply CIS. But that's a very, very low threshold. When it comes to the definition between property investor and property developer, we believe it's much more about the definition of the activity, what is actually happening. So, for example, if you buy a hotel and turn that into a number of residential flats, or if you buy a commercial property and then you change some of that commercial property into residential flats. If you buy a property and extend it considerably with changing the number of flats, those type of things we believe will very much be seen as development. Now, even if your intention is that you want to rent it out afterwards, but for the period of construction work, you would be considered a property developer. Now, many of our clients will then make the comment, yeah, but we're using a main contractor. They will deal with all of these subcontractors. Now, as I said earlier on, HMRC doesn't actually make a difference between a main contractor. They are a contractor and a subcontractor. A main contractor, if you pay them for developing your property, then they basically become your subcontractor. Now, it is quite easy for you to comply with CIS in that case, because hopefully it's a main contractor who's done work many times before. They are registered for CIS with HMRC. They have something which is called a gross payment status, where you can pay them without any deductions. And therefore, all you need to do is register yourself as a contractor, verify this main contractor, and do a monthly return with one entry. But if your main contractor is not that type of main contractor, then you may have obligations to look at, all of the payments you make to subcontractors. So once, as an investor, you become a property developer, the 3 million threshold does not apply. You need to apply CIS on all payments to subcontractors. Remember, it only applies to the labor element of the work. Remember the different kind of the definitions of construction work, because that is also important if the work is VATable and it's linked to the VAT reverse charge. So what are actually those contractor obligations? Well, first of all, you have to register as a contractor stroke employer for CIS. You have to verify your subcontractors through HMRC. Verification means you need to check with HMRC, are they registered and what kind of status do they have? There are 3 statuses, one which is not registered, in which stage you need to deduct 30% of the labor element of the payment from your payment. Then there is a standard registration, which still means you have to deduct 20%. And then there is a so-called gross payment status, which usually applies to construction companies that have met certain turnover thresholds and also have complied with all CIS obligations. In which case you don't need to make any deductions, but you still have to put them on your monthly return. If you do make deductions, you have to issue a subcontractor statement, because that is the evidence for your subcontractor to reclaim the CIS that has been paid to HMRC on their behalf. You have to do a monthly return, which is due by the 19th of the following month. That includes nil returns. So say, for example, most of the development has finished. There's only sort of some minor things going on, but really you've now entered into the retention period. Because retentions fall under CIS, you stay registered for CIS, but you can apply for a 6 months break where you don't need to do the nil returns. But it's important to watch that 6 months break. And you have to pay over the deductions you've made to HMRC by the 19th, and there are late payment penalties. Now, we did mention that we've also dealt with overseas investors and overseas construction companies. So the bad news for them is there's no exception for foreign companies. It covers all construction works in the UK and also within UK territorial waters up to 12-mile limits. So, for example, where wind energy farms have been built in the Thames Gateway, that fell into this under the CIS. Contractors obliged to operate the systems properly, and that includes payments to foreign subcontractors who also would need to be registered here in the UK. Foreign subcontractors will find it more difficult to register for CIS and especially for the gross payment status, because HMRC doesn't have their history. So you need to bring in a lot more evidence whether they've paid their corporation tax, income tax, and so on and so forth on time. And you have to translate all of the documents. Now, many clients will always ask, what if I don't do that? How do they know? Now, obviously, we can only advise you on what the correct treatment is, but the system is being monitored. There's an annual compliance review of subcontractors with gross payment status. And that is quite a significant review that doesn't only look at have they, paid, operate the scheme, the CIS scheme properly, but it looks at whether your corporation tax payment has been made on time, whether you've filed your annual accounts on time. So it's really quite strict. Now, the other way on how HMRC picks out on non-compliance is through VAT and payee inspections. So a lot of investors, for example, will have a VAT refund in during the development. And as part of the refund, you always get a questionnaire as to what is happening, and the questionnaire does include whether they are registered for CIS or not. So there are quite a lot of links. So we would not recommend not following the procedures properly. But if you need any more information on this, we are here to help. And the earlier you ask, the better. Thank you for your
Petra.
time.
And Simon, so we mentioned that for CIS and overseas investors, same because it's a UK property, the same setup. I imagine it's the same for VAT. Overseas German company buys a UK property or such like. How do they set up? Is the same issues for VAT? It's just you register the property effectively, the business in the UK.
Well, yeah, I mean, look, it depends whether or not it's a commercial property being constructed or developed or residential. But overseas companies, they don't have to have an establishment here. There's a special unit at HMRC. We shortly shortened it called NETBU, which is Non-Established Taxable Persons Unit, and they basically deal with overseas entities who want or have to be registered for VAT in the UK, but have no establishment here. It's just dealt with by that team within the VAT registration unit. But again, it depends what the development is, but we can generally deal with that. I mean, I've got to say, Jason, there are some overseas clients who don't have to or want to register for VAT. For example, if they're dealing with a big existing residential block of flats that they're just majorly refurbishing, even if we were to get the 5% VAT rate on the works, there's still no VAT. The income will be exempt, so there's no requirement or responsibility to register for VAT. But we have to look on a case-by-case basis. But that's very quick, just to determine if there's an issue in the first place.
Okay, thank you both. I think my key takeaway from both of your points is that, and with property transactions, it's best if the planning up front is done as soon as possible. On VAT, looking at planning permissions, ensuring that what we're getting in the documentation relates to the kind of the VAT that we're expecting to get, we could be charged, because later on, if it's incorrect, it's quite difficult to unwind. Same with CIS. I think the point is, let's have a think about whether we do fall within the scheme. Make sure we're registered so we don't cause ourselves any pain later on. So getting advice as soon as possible, I think, is the key to both of these. Just final point, Simon or Petra, have you got anything else to add before we say goodbye to everybody?
Well, I think from my point of view, obviously, there's only so much I could cover today. It was very, very high level. There's always a lot more detail that goes in behind. So obviously, if anybody has any projects that they might have a query of, please give me a ring. Happy to have an initial chat and take it from there.
Thank you.
Yeah, nothing more from me. Sort of, really just, thanks everyone for your interest. And if we can help, we'd love to.
Thank you very much. Thank you everyone for joining. We'll see you all on the next one.